So next on our list, I was looking at JD Wetherspoons' not earnings report, trading update for the 12 or so weeks going into the end of about last week, basically. They reporting an interesting sort of time in the cycle, which is to say they are shortly behind the reports from Marston's, Mitchells and Butlers, Fuller's, most of the other kind of pub chains. They've already kind of given you a rough idea of what they were looking at. Everywhere I was reading said they've beaten the rest of the sector. I'm not quite sure what they were reading. I've got Mitchells and Butlers at 3.9%, Fuller's at 5.9%, and Spoons at 4.6% in terms of like-for-like sales growth, which is not worse, and it's not obviously better either. They all report in slightly different time windows, so there's a bit of not quite the same comparison going on here. But when you consider inflation is at about 3.5%, 4.6% like-for-like growth it's growth. It's still genuine growth. It's not particularly earth-shattering growth, and I think that's roughly the story here. I didn't see that there was an awful lot to be inspired by one way or another, as 1.2% down on the day. I wouldn't probably have argued with 1% or so either way, depending on what the rest of the market was kind of doing. Tim Martin, of course, likes to use these as a chance to get onto his soapbox and pay attention to, get people to talk about anything that get people to listen to anything that he'll say, which is invariably the same thing, which is that supermarkets pay less tax on food. And if pubs came into line with supermarkets, their lives would be much easier. In general, I think his comments here worried me more than they normally do, actually. The way I've usually thought about Spoons is in terms of its competitive position versus other pubs, and actually had quite a positive view on that. I worry a little bit about the sector as a whole shrinking down here. But we will see how things go. I still maintain a sort of fairly positive view on this, but the idea of thinking that if you're trying to be a low-cost provider, your bigger threat is people going away. We will come back to this theme in a bit in Netflix. People leaving the industry entirely, basically, rather than people trading anywhere else. That's interesting to me. Steve, any thoughts?
Yeah, I don't really often have sympathy for him, as anybody who's listened to the show will know. I think he operates within the environment that he operates, but he does permanently have that point of supermarkets not paying VAT in respect to food sales, which allows the supermarkets to subsidise, if they'd like to, the price of the beers that they sell, and Wetherspoons are not afforded the same luxury. But it's the report sort of doesn't lend itself to somebody who is actually asking for a favour from the Labour government. I mean, he has like yawn written in it and things like that. It's not the most. It sounds like it was written by an angry man, and sometimes Tim Martin comes across like that to people. But at the end of the day, he has got a point, and some of the interesting stats in here that he's pulled out is Morgan Stanley calculated that beer volumes on-trade beer volumes, that is pubs, clubs and restaurants, have decreased by 52% in the last 23 years. And actually, it's a reason I'm sort of not interested in pubs themselves, is that I think there's quite a shift away from drinking in this younger culture. The junior at our place just there's no interest in it whatsoever. If he goes out, he doesn't even think about a beer or a drink or anything like that. And he's not on his own in that. His friends are all very similar as well. They don't like, when I was his age, like I'd have stopped off to pick up some nice beers or wine on a Friday after payday, so I could sit down and have a drink with my missus, and they don't think about anything like that. So, it's interesting to me. I worry for Tim Martin here. I worry for the pub sector. I think he's highlighted what could potentially be. He's highlighted the bear case, essentially, hasn't he? Here, and we'll have to see how that plays out.
He always does a little bit, and there's a sense in which, I mean, the business is kind of doing fine right now, and there's been times in the recent, you don't have to think back too far into the recent past to think there are times when the business has been in trouble, like in real trouble during the pandemic and so on. I mean, he's one of these CEOs who never likes to talk too positively about how things are going, because he's worried someone might be listening and they might start saying, actually, yeah, you are making quite a lot of money, tax. And I get that sort of thought. But the trouble with constantly talking down your position and talking up the kind of permanent obstacles that you face is that people do stop paying attention when it's actually kind of serious. There's a little bit of not quite crying wolf here, but he's always found something to be cross about. Usually this, in fairness, is usually the same thing. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.